Good afternoon. What a week we've got. The GDP number is officially here. We'll break down a little bit more of earnings season updates, especially with the big tech companies reporting this week. And of course, the Fed was back in focus on Wednesday with the rate decision and interview with Fed Chair Powell. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday at 3 is to bring to you the market news, the data, the trends that we're watching, and weed out a bit of the noise along the way. So we have a ton to cover, as you probably get a sense already here this week. But hopefully you're enjoying the sun, staying cool here if you're in the Pacific Northwest with this heat. We're going to jump right in though, because we have so much to cover. And before I get to really the meat of it, I want to just touch briefly on a data point that came in Tuesday this week, which was more negative housing data. And, kind of carried over from last week. So if you haven't had a chance to listen to last Thursday's session, go ahead and take a look at that. But for the first time, we're starting to see a little bit of a reduction in the optimism around housing. All right. With that, let's jump into what we're really going to spend some time on today. And maybe the first thing I'll start with, probably the easiest, I guess, is the Fed. So just yesterday on Wednesday, the Fed reported that they will be raising rates by 75 basis points. In other words, 0.75%. No surprise here at all. This was just as they had expected. There were some concerns, also some optimism, depending on which side of the inflation coin you're on, that they may raise rates by 100 basis points or 1 full percent. But they did not. They kind of stuck to their plan. They raised by 75 basis points as they had kind of outlined previous meeting. And I think the key though is that they changed their tune entirely. So up to this point, looking backwards, and even prior when they were reducing rates, they really set a clear path on what this looked like. They said exactly what they were going to do next meeting and tried to portray what that path looked like moving forward. In this meeting, that changed quite a bit. They still gave their guidance for year end, I believe, or into 2023, but they were very, very hands off, saying that, we're not really going to give direct guidance on what's coming next meeting, which, by the way, I believe is in September. They shared multiple times that the rate forecast should be taken with a grain of salt because they're going to watch the data. They've said this multiple times, but a little more hands-off this time. Watch the data and make decisions as that unfolds. So I think this was a very different change in tune from the Fed. For those who follow, you probably noticed the markets spiked off of this. They were up pretty good leading into it, but basically as the Fed, kind of took more of a dovish tone, I guess you can say, the markets really liked it. They took off. The NASDAQ, I think, was up like 4%, something like that yesterday. So it was a great day in the markets, a good rally given what we've seen here as of late. But will it continue or not? Obviously, some of the earnings we'll talk about and GDP numbers may tell a bit of a story there. All right, the second piece I will touch on is the earnings side of things. So basically, this week is just earnings galore. We've got Google, Microsoft, Boeing, Apple, Amazon, Meta, you name it. I think it's something like 30% of the S&P 500 valuation reported earnings this week. So it is a big deal. And I think what's interesting is that so far, earnings have been kind of okay. Probably, maybe leaning towards the not good side of things, if anything, because expectations were already so low that, we're kind of at like an average-ish beat versus miss kind of ratio right now, but we still got a lot to go. But that's been kind of the case. The challenge is that, expectations were so low that even as these companies are beating, is it really that great? And a lot of companies have shared some forecasts moving forward that their expectations for the rest of the year are down quite a bit. So earnings are still a little bit mixed. It's hard to get a full story quite yet. We'll know obviously a lot more here in the coming week as some of these other giant companies start reporting. But for the most part, earnings have not been that exciting yet. With the Fed and some of these more macro picture or items at work, the markets have really picked up here this week, on the back of some of that data. All right, the next thing to touch on, the third thing, of course, is GDP. So this is a big news story. You probably have heard about this if you follow the markets. Today on Thursday, the first glimpse at GDP numbers came out, and it was down 0.9%. So let's not say officially, let's say technically, by the textbook standards, we may be in a recession. If you look at the textbook standards or the technical standards, it says 2 quarters in a row of negative GDP equals recession. I think that, I don't know that that's the best way to look at this. I'll share more here in a minute, as our question of the week is really, how do we know if we are in a recession? So I'll share more about that. But nonetheless, today, the GDP number did come out, and it was negative for the second quarter in a row. Even with that, the markets today are up for the most part. So, even after yesterday's rally, there's still a little bit of upside that we're seeing here today on Thursday, even with this negative GDP print. All right, coming up next week, before we get into how we know if we're in a recession, we have inflation data, we have job openings, and kind of the start of jobs data starting to come out there next week, which will carry into the following. But this may start to give us a glimpse as to whether or not we are really in a recession, which is a great segue to our question of the week. How the heck do we know if and when we are in a recession? So as I had shared, the textbook, or the technical side of this says that technically 2 quarters in a row of negative GDP means we're in a recession. However, that is not the reality of determining whether we are in a recession or not. It may sound kind of strange, but it actually is up to an organization to determine whether we are or not. The National Bureau of Economic Research is the organization who officially determines whether or not we are in a recession. Looking back historically, when we've had 2 negative quarters of GDP, it has meant recession. However, things are a little different, and I'll share more about that here in a minute. But nonetheless, really what we are looking for to determine whether we are in an official recession or not is the NERB, I believe is the acronym, sharing whether they determine or not that we are. So that's really what we're watching for there. But, obviously today's GDP number was important towards that. It's interesting because we hear so much about this GDP. So to break this apart a little bit, we hear so much about this GDP number determining whether we're in a recession. The NERB has actually shared in the past, I think I had run across this, that they don't even use GDP as a measure. They had suggested that GDP is not even a factor in their determination of whether we're in a recession or not. So we hear so much about this, but at the end of the day, is that really the measure? Not according to the organization that determines it. They look a little bit more at gross domestic income as part of that measure. But they also look at jobs data. They also look at, it's really just economic activity, right? How they determine this is if economic activity is falling. And right now, obviously we have inflation, which can be a factor towards this. But, as you probably are feeling yourself, the economic activity is still pretty robust. So, it'll be interesting to hear what they say. Again, from the textbook perspective, we may be able to say we're in a recession, but we'll find out soon when they share their glimpse into things here, probably not too far down the road. But for those who are curious about this, we are actually hosting a free online learning session coming up on Thursday, August 18th, I believe it is. Where we're going to be breaking down this. So again, technically we are in a recession today. We're going to talk about whether we really are, what's next, and what may be in store for the year ahead. So if you want to join us, I'll put a link just in the comments below as well. You can pre-register to join us on that Thursday in August. But we'll keep you posted, obviously, in our weekly updates moving forward as well. Next week with the jobs data will certainly help to tell a bit more of a story. So join us next Thursday at 3. Hope you stay cool in this heat this weekend, and we'll see you next Thursday.